Hello, everyone. It is 12th of October, 2023, and we are having another Marketimers team talk. We will have Angelo today. We will have Svata talking crypto. Very interesting stuff. But before we start, I have to say this disclaimer that nothing that is said in this program is intended as investment advice. Before you put any money into the markets, please advise your advisor. The purpose of this video is purely educational. By participating in this call, you agree that this video will be posted on YouTube. If not, please disconnect. Okay, so now we can start. And first, I would start with looking where we are on the ranges. Can you see my screen well? Angelo?
Yes. Yep.
Okay, so last time we had the talk, we were discussing bonds. We were somewhere here. Yeah, we were noticing this important line. It's either going to make it or break it. It broke down, and it's a big flush. Now, lately, everybody on FinTwit is a huge expert on bonds and where they are going down. Even those who were, bullish all year and last year. And this is a situation in which it's kind of getting kind of panicky, and it's a situation where usually bear market rallies start. But I will leave this theme to Angelo for later. As we can see, we are on the low of the range on the monthly. Even if we go to quarterly, we are on the low of range on the quarterly. So if you are short, just don't short it here. Definitely don't do that, please. And if you are short here, please risk manage, take some profits or maybe even all profits. This is the location where there will be some response, very likely. Of course, nobody knows how much lower it can go. We didn't see yet the kind of capitulation day on bonds, but if we look at TLT, we have seen some sort of like capitulatory volumes. But I don't know, this is a very complex market. There is lots of hedging. Bonds are collateral. So it's very difficult to consider it like equities. Anyway, if we go to equities, if you look on the quarter and euro chart, we are threading the same prices since July 21. So basically, we are 2 years. 2 years we have been trading the same prices. Now, if we look at RSP, this is the ETF that represents S&P 500, but equal weighted, because the S&P 500 index is overweighting those biggest companies. Based on capitalization, they are giving them higher weight in the index, and this is equal weighted. So you can see that we are really in the middle of some price action that is almost 2.5 years old. So investors are really in a big pain. I mean, do not listen to people who write on Twitter that we are in a new bull market. I mean, they're lying. There's no new bull market. I mean, every investor is in pain. They've got no returns on their stocks for 2 years. They're threading still waters. It's very stressful for them because they had a huge drawdown last year. Basically what money managers, they are desperate because they are not getting performance. So what they are forced to do, they're forced to concentrate capital. So they are selling small caps, they're selling all the stocks, and they're buying the stocks that all the world owns, the 7 top stocks. And this concentration is very dangerous. And I'm sure that Angelo will also hit on this topic a little bit later on. So if you look at what a typical investor who is trying to save money for retirement, last 2 years must be painful for them in stocks, in bonds. I mean, most of the pensioners or people who are saving on pensions, they don't even know usually, but about 30 to 40% of their money is bonds. And as you can see, TLT is down from all-time high. The wrong tool to measure it, sorry. TLT is from all-time high is down basically 50%. So 50% drawdown in bonds. And bonds are not stonk. They are not, this is not Tesla. This is nothing like that. You will not have new all-time high in bonds. I mean, that's it. That's like all-time high forever. Unless rates in the United States go negative, which I don't think is possible anytime soon. Anyway, that's also a theme for Angelo. So yeah, investors are in big pain. I mean, if we look at Bitcoin, so those who invested in Bitcoin, and I remember Angelo telling me stories about some clients that would pull out all the money from their portfolios and put it into Bitcoin, buy it for what, $50,000 or $60,000. So yeah, these people are right now, they are in a 61% drawdown. So investors in any kind of asset, except those who are in short-term treasuries, and they are not, because most of them would buy a long-term duration, and they would not buy the short-term. And we are talking here already since the hike season started, we were talking about going into short-term treasuries. So we got it right here on Marketimers. So yes, we are in a bear market. We are not in a bull market. I mean, if somebody's telling you are in a bull market, they're lying, or it's their wish. They're wishy. They wish they would get out of their drawdown. And yes, we have a bull market in top 7 stocks where all the world's capital is concentrated. And as we have seen in 70s, those stocks can go even higher. Anyway, so S&P 500 on the ranges, we are in the middle. We are kind of in the middle of everything, so it's a very choppy price action, as you can see. The weekly time frame is getting red, the monthly is green, but in general, we don't know. This is a Brownian motion. This is entropy, and if somebody will tell you with high confidence that from here you can make a big home run up or a big home run down, they're going to be lying to you, because statistically we are not at the spot of some extreme from which we could produce a big. So yeah, what makes money is short-term trading from options levels. That still works really well. Anyway, if you're in the middle, don't trade at all. Just take the day off. Anyway, yeah, Nasdaq is in the middle. Russell is on the low of the range of this very long consolidation. Basically, we are trading the same price as we traded in May 2022. So this is basically almost a year and a half of consolidation. We are now on the low range. So statistically, more probable is that there will be a mean reversion to the center. But at some point, there will be a breakout. Yeah. So if the breakout is to the downside, it's going to be very ugly. Gold, yeah, very difficult time for gold bugs because real rates are positive. So, I mean, why would you hold on to gold if you can have treasuries yielding quite a good money? So yeah, I'm not big in gold. Anyway, Angelo will also discuss that. Maybe he will have different opinion.
You're asking me to talk for 2 hours now.
Oh God. And so yeah, let's look at commodities a little bit. We've got a pullback in oil. Sorry, commodities. So we got energy. Let's look at energy. So it looks like natural gas is green on monthly. Natural gas is green on weekly. And consolidation index is getting below 50. On weekly, it's getting there. So, I mean, yeah, we saw a little bit of breakout. So natural gas is strong. And if I will be in my trading shoes, I will give it a shot on the low of the range long. Oil is green on weekly. It's green on a monthly. The consolidation index is showing trend, or that the market has a memory. Still, unfortunately, on the monthly range, we are not low enough. But yeah, last week I was adding into the on the low of range of weekly. I was adding into my GSG long position. That's the kind of commodity index, which is very heavy on oil. And from Europe, we can trade it without getting some extra shaving tax. We can look at the DBA and the agricultural stuff. That's consolidating and holding higher prices, even though wheat was kind of weak. Uranium also is at the low of range of weekly, and the weekly monthly is, you know, green. But always keep in mind the bigger picture. The bigger picture is that uranium is still within a consolidation that is already 2 years old. We are still threading a 2 years old consolidation. So if you go long here, you need to go long on a short leash. You cannot wait, buy it and hold it forever. You have to manage your risk. Did I miss some important markets? Maybe let's look at some international markets, and then I will give pass the microphone to Angelo. So let's look at China. China is red on all time frames. However, on monthly, we are on a low of range. So yeah, there is some sort of consolidation. I mean, definitely I would not short it here, but going long, I tried it through REMX, which is the Chinese rare earth companies, and I'm not doing very well on that one. Yeah, so I'm waiting for top of range to get out of that position, which is now in drawdown. Nikkei. Nikkei was on top of the range of this trend channel. So then it retraced to the middle of the channel. Now it tries to rally again. We will see. I'm not betting on anything at this point. India, looking through dollar denominated basically dollar denominated ETF of India is consolidating already 1, 2, 3, 4, fourth month. So we'll see what happens out of this consolidation. In general, in bigger terms, in dollar terms, India is trading the same prices since August 21. So it's 2 years, the same prices. We see it all over the place, in all indexes, everywhere. We are in a 2-year consolidation, and we don't know how this turns out, because I still think that first they will attempt higher, and then there will be a big failure. But I don't know. It's just opinion. It's not like statistical property. Europe. So we have we have unclear situation in Italy. Eurostox. Eurostox try to break down from this multi-month consolidation. Now it's actually looks like it was a fake out. It's trying to get back into the consolidation space. So I reduced my shorts at this point. So yeah, also very unclear situation. We have short-term correlations went really strong all the way to 0.9. I think this is the biggest reading of this year. Now it went down to 0.62 for cross-sector correlations, which is lower, but it's not very low. Yeah. So yeah, I don't know what's going to happen. We are in the consolidation, and this is what it is for where we are in price ranges. So now I would like to welcome Angelo, and please give us your view on inflation, central banks. I think this is what you really understand well. On the banking, again, the loans are now on a historical lows, similar to the great financial crisis levels. What is your view on all of this?
Okay. Like I said, that's enough to talk for 2 hours. But what I'd like you to do, Dave, is just put up a spread, gold versus GC 1 exclamation divided by ZB 1 exclamation. There you go. Let's just put that up for a minute. And just, I'm going to let that sit there for a moment. So the big event that happened this afternoon here in the US is that the 30-year Treasury bond auction did not go very well. So the rate on the 30-year bond spiked from 4.13 to 4.83 this afternoon. And so if anyone's wondering, was there some news? What happened where all of a sudden the Dow went from flat to where it is right now, which is, I don't know, it's minus 260, minus 270, right? So that's the issue that happened this afternoon. A 30-year Treasury bond auction that didn't go very well. So now let me just back into my bigger picture framework for a minute. So David, you can leave that up if you want. All right, we lost your David, unmute yourself. Nope.
I took down the screen share because then we cannot see your face very well. So
okay.
If you want it back, let me know, but so we can see
the
speaker properly.
All right, we'll bring back some charts in a few minutes. So the bigger picture framework, and what I'm about to say also applies to Europe too, to a large degree. Most of it also applies to Europe. But here in the US, as everyone knows, government spending is out of control. We have the Inflation Reduction Act, whose cost is continuing to rise, and no one knows what the final cost is going to be. We have the Federal Reserve insisting that they're fighting inflation. I don't believe them. And I'll just say this. If the Fed raises rates anymore, that makes the US budget deficit even worse. I don't believe that the Fed has what it takes to slow down the US economy enough to where it could actually get inflation down to 2%, despite the fact that the Fed's monetary policy is butting heads with US fiscal policy. So on the one hand, the Fed's trying to reduce inflation, and on the other hand, the federal government is spending like crazy, and that's where the inflation is actually coming from. Now, if we go back to the second quarter of this year, US GDP was unexpectedly higher. Why? Well, the components of GDP are government spending, investment, consumption, and the netting of imports and exports. Well, those latter three components were lower. The only item that was higher was government spending. And that's the only reason why you get the talking heads on TV claiming that, the US economy is actually growing. No, it's not. The US government is growing, but the US private is actually declining. Now, I've read some estimates.
Sorry, Angelo. Looks like something is with your internet connection. It's showing me that your internet connection is unstable. Is that possible, or something is wrong on
It's
my side?
possible. It's possible, but that was yesterday.
Yeah,
Today it's been working fine. And it looks like everything's working. My
yeah.
screens are
So it
all
was a temporary. You can go ahead. It was a
okay.
temporary. Yeah.
All right. All right. Hoffrey said he can hear me fine. All right. So you have government spending. It's butting heads with monetary policy, and that caused GDP to appear stronger. But the U.S. private economy is actually declining. Now, if the Fed wants to stay on this path, the estimates that I've read suggest that GDP would have to slow down 4, 5, maybe 6 percentage points in order to actually crash the economy. And doing that puts us exactly where we were at the beginning of COVID, because that's how much GDP declined at the beginning of COVID. Okay. I don't believe that Jay Powell could withstand the political pressure of doing something like that. So all of my work, all of my technical work, everything that I'm looking at is telling me that the path of least resistance, the outcome for all of this, is that we are going to have structurally higher inflation for as far as the eye can see. China is no longer going to be the manufacturer to the world because their governance policies are chasing foreign direct investment away from China. And we're getting what we call onshoring here in the US. But that onshoring is not necessarily efficient. So it's going to be more expensive. What's expensive mean? I think the fancy word for saying it's going to cost more, which means that's a further prop to inflation. So what I see is that political parties and the Fed are going to take the path of least resistance, which is, okay, we're going to let inflation run hotter for longer because that way, we can theoretically inflate away this debt burden. I'm not a big believer in the concept of inflating it away because to me, that means that if you want to inflate away your debt burden, you have to stop incurring more debt. And then you can inflate it away and get it down to a more manageable level. But if you keep spending the way that they're spending, you never actually accomplish that goal. And all you do is destroy the economy in a manner similar to what happened in the mid to late 70s. And then Paul Volcker came in and made himself famous. But I will say, and this is interesting, that so far, Jay Powell, he's got a few more months left to go. But if Jay Powell stays at these levels, he will have remained restrictive longer than Paul Volcker ever did, which is sort of an interesting thing to think about. But be that as it may. So that leads us to portfolio allocation. How do we think about things like gold, bonds, currencies, right? Everything. And if you go back to that chart, gold versus bonds, David, that's an important chart. Okay, that's an important chart. And David, why don't you bring in the tail duration chart? Maximize the tail duration chart. All right. So, you can see that in now, by the way, let me back up with gold for a second. I know you said, David, you don't really care for gold right here. And as a standalone, no. Okay. But if you have a risk spread on, all right, you're protecting yourself from just owning gold outright. And I agree with you. No, you don't want to own gold outright. But if you do it in, as depicted here, gold versus bonds, you've got some protection. And what that chart is telling me is that the market agrees with the fact that it's going to be inflation, but with a twist. And this is going to be a twist that we've never had before, but this is what I'm looking for. So bonds today, David, failed at an important technical level. Oil today failed. It rallied to nowhere and failed. Gold is still holding up in and of itself. Okay. And also the S&Ps and the NASDAQ all failed at an important spot today and reversed lower. So, today could be a catalyst for further downside. We'll have to wait and see. But what I'm looking for in the bonds, David, is for us to violate, and maybe now you can just go to bonds, David. Go to ZB.
You said ES failed at an important level. It's our ES matrix 4409, 4408, 4409. I mean, we have been talking about it all year last year, right?
Yep. And why did it fail there? Well, we had a matrix level there, but more importantly, we also had a pretty wide pit gap there, and we filled about 2/3 of that pit gap. Okay. Yeah, exactly. And we failed. That's not good. That's bearish. From a short-term trading perspective, that's bearish. Okay. So I look at the board today and we had a lot of failures in a lot of things. So now go to bonds, go to ZB. And go to Wednesday's low. I'm sorry, Friday's low. Today's Wednesday. 1, 2, 3, 4 bars from the right, David, including today. Friday was one more to the right. I'm sorry, go back. Tuesday, Friday. Okay. Friday's low. If we violate that, the bonds are going to go to par. All right. My thesis is that if we violate that, the bonds are going to head towards par. What's par? 100. A bond, a treasury bond, or any bond is worth at face value is $1,000. So right now, treasury bonds are trading at $1,110. Okay. If we violate Friday's low, which was 110.29, that opens the door for par. Now, why am I? That's going to be phase 2 of my framework. Phase 1 was technically getting down into that 108 range. So Friday's low, I think, was 108.29. Sorry, I said 110. It was 108.29. And so that was a really, really big spot, David, on the life of contract fibs. Okay, really big spot. And we were expecting a technical rally. And we got the technical rally in the bonds to the tune of about 2 points on Friday. But the bonds still closed lower on Friday. And this is important. So the fact that the bonds closed lower, got up here yesterday and this morning, up to we got to 114.10 this morning in the 30-year treasury. We needed to get to 115.25. Couldn't get there. It failed. And then this afternoon, we get this treasury bond auction. All right. And now the 30-year bonds are down 2 points. Okay, that's getting ugly. So The first part of my framework, which happened on Friday, was the bonds go down. They hit that big technical level, that multi-decade technical level. We get a rally. We get a rally in stocks. We get a temporary rally in the bonds. And there was potential for the bonds to go a lot higher, by the way. Okay, but they failed. And the bonds could have gone to 117, but they couldn't. So now part two of my framework, and Pete's familiar with this, is that now we violate Friday's lows, we violate the 108.29, and we start heading down towards par. At that point, the 30-year Treasury bond would probably be yielding probably somewhere up around 5.5% to 6%, somewhere up there. Okay.
So, Angelo, that would mean we would basically get out of the inversion on the yield curve, right?
No. And well, you know what? Hard to say. Hard to say. But I think I know where you're going, and I'm going to get there.
Okay.
So if we start heading down towards par in long duration, the Fed's going to have to step in with something. All right. They're going to have to step in with some type of bond buying program, whether it's outright QE, whether it's an expansion of repo, whether it's an expansion of the bank term funding program, and something that happened in Europe in July, which is the ECB lowered the interest rate that they're paying European banks on reserves. That could be coming here to the US. Okay. But anyway, let me just set that aside for a moment. So the Fed will step in, and let's just call it yield curve control, like Japan. For lack of a better term, the net result would be to stop interest rates from going too high, right? Because that's going to completely obliterate the US federal budget. It will completely destroy it. At that point, interest expense would be well above what the US spends on military spending. Okay, so the Fed will have to step in. Now, David, go back to the gold bond spread. Okay, so that's what that chart is telling me. It's telling me that the Fed at some point is going to have to step in. They're going to cap rates. Inflation is going to go crazy. And that's going to start generating negative real yields. And that's when gold will probably go through the roof. We could wake up one day and the Fed will announce some form of bond buying program, and gold will rally $150 or something. I'm just making that number up, but it'll be up big in reaction to the Fed stepping in, right, with a bond buying program, which then makes inflation worse.
And probably that day that you are talking about, this day of introducing the new kind of easing program or the yield curve, whatever, it's not going to be only gold going up, but I think that will be the next leg of the Ponzi stock scheme making new all-time highs, right? Probably.
Well, I've been thinking about that, and not all stocks, I don't think. I think only those stocks that will have pricing power in a inflationary environment. And I'm not talking about a 3% inflation environment or a 4% inflation environment. I'm talking about an 8% inflation environment or higher. Okay. So I'm not sure yet what those might be, but could it be large cap tech? Probably. Will it be small caps? Unlikely. Will it be utilities? Unlikely. Will it be consumer staples? select ones. And why do I say select ones? Yesterday, it was interesting that Pepsi came out and said, they were able to raise prices. Now, Pepsi has not had real earnings growth in a long time, but they are consistently able to raise prices just enough to keep up with their cost inputs. And the stock market liked what Pepsi looked like the other day, and Coca-Cola went up even more on that same logic. So, might there be certain consumer products companies that will be able to keep pricing power or maintain some nominal pricing power? Yeah, there could be. But it's going to be hard to know in advance, because the trouble with all of this is that we've never been in an environment like this before, where we had quantitative easing, the Fed's trying to unwind it, a government spending like crazy, and then a Federal Reserve that could potentially have to step in to cap interest rates in order to keep the federal budget from blowing up. Now, Chris Whalen wrote an interesting piece yesterday. And in it, he basically says, you know what? Jay Powell needs to stand up and tell Congress that they need to cut spending, and they need to cut spending now. Is Jay Powell going to do that? Well, so far, he's reticent to do anything like that. Will he? I don't know. The political blowback from him coming out publicly and reprimanding Congress for doing what they're doing, hasn't happened in a long time. I think the last one to do something like that might have been Irving Fisher in the 1930s, maybe. Hard to say. So, for now, gold versus bonds. Inflation is not going away. We have to be very, very careful in this moment in time of the big seven. NVIDIA, Facebook, Google, Amazon, Microsoft. And the reason I'm saying that is because a lot of liquidity is coming out of the bond market, and it's going into those big seven names. And the perception here is that those big seven names are now the safety trade for this.
Yeah, I heard arguments like, Google and Apple, they've got so much cash, and they probably store it into the treasury, so it's better to own their stock than treasuries, bullshit, like things like that.
Yeah. And you know what? They may hold up for a while, but eventually, when earnings really start to take a hit across the board with everybody, right, they'll go down with the ship. You see? So we're in some really serious stuff right now. And the last thing I want to talk about very briefly is something called fiscal dominance. And fiscal dominance is when the federal government overwhelms everything, and the objective is to get as many private parties and government entities as possible to buy treasury bonds. So one of the things that's happening right now in Europe is that the ECB lowered the interest rate on bank reserves. Okay, well, European banks didn't react too well and haven't been behaving very well since July, when the ECB implemented that at the last meeting. And so something like that looks like it could be coming here to the US. Now, yesterday, Holtzman, I think his name is Holtzman. He's the reserve governor for the Austrian Central Bank. Yesterday, he put out a statement saying he wants to take this reserve stuff even further. And what he's proposing is that the ECB only pay interest on 90% of the required reserves that banks have to have. So that means that 10% of the reserves that they have, they're not going to earn any interest on. And he wants to force them to use that money more productively, whatever the heck that means. Okay. Now, here in the US, if something like that were to happen here, where
That sounds like a confiscation, right?
yeah.
Yeah.
But if something like that were
It's
to
typical
happen
in
here,
Europe. We have a communism here, which comes in these strange rules that they look like socially responsible rules, but they are, confiscation. They are, once again, and we went through it in the Czech Republic in 50s when they started collectivizing property, and now it's happening in England, in Spain. For example, you own apartment, right? And you rent it to someone. And there is a legislation, once you rent it to someone, you cannot kick him out for another 5 years. You are no longer, you don't really have the rights to your investment, to your property. So this is what's happening in Europe.
yeah, terrific. You know, so here in the US, if they did something like that, on the surface, it would be bad for banks. And you would think to yourself, oh, okay, I'm going to want to short bank stocks. Okay. However, I feel like if they lowered interest on reserves here in the US, they would be reducing banks' ability to buy treasuries. So what that means is that if they pay less in reserves, and by the way, bank reserves are declining as QT continues. So QT actually reduces bank reserves. Okay, so that means that not only would banks be earning less interest, but the balances that they have on deposit at the Fed would also be declining, further reducing the amount of interest income that the banks earn. Okay, so that means to me that regulators would have to open up some form of a safety valve. Now, a safety valve in what way? They would have to relieve what's called the supplemental loan ratio. That's what banks have to reserve against various assets, including maybe treasuries. So they'd have to relieve that. They would have to open up other avenues to allow banks the ability to go buy treasuries at these higher rates. Or say, okay, you know what? You can only buy treasury bills. All right, well, treasury bills now at 5.5%, the banks can, dig their way out of this hole. So that's a part of fiscal dominance where the regulators structure things so that it kind of forces bank to have to buy treasuries. So, that's something else that I'm watching right now. David, let's just go back to that gold bond chart. I want to show you a different way to look at it. Okay, so what I want you to do is I want you to do GC no, yeah. Nope, 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 nope. Go back.
Long gold, short bonds, right?
Long gold times the 30-year yield. So back up.
Times, okay.
Okay, now do asterisk, US
30.
330Y. Y. Add Y.
Yeah.
There you go. Okay. That's basically saying long bonds, long gold, short treasuries, except I'm just expressing it in terms of yield. Okay. It's just another way to look at it. And as you can see, the conclusion is the same, is that you want to be long gold and short treasuries. That's the big trade right here, going into a further failure in treasury bonds, which when I and Pete can probably speak to this as well, is that the federal government or look, we have elections coming up here in the US next November, a year from now. And there's no question in my mind that Janet Yellen is going to have to play some games with the Treasury General account, right? She's going to have to fill it up right now so that mid-year next year, maybe April, May, June, right? She can start to spend it down in order to pump liquidity into the system in order to get the stock market to rally ahead of the presidential elections. So in order for her to do that, she's going to have to issue lots and lots of bonds and then figure out how to hang on to some of that cash so that she can spend the Treasury TGA account, close to zero, like she did back this summer, which is what caused the stock rally from April, May into the July highs, right? Because July is basically the high for the Russell and the S&Ps and the NASDAQ, you name it. You see? So there's a lot of stuff that I'm watching, but as far as I'm concerned, we're going to have structural stagflation. It's not going to go away. And the end result is going to be that they try to inflate away the debt. And the only question is, how high does inflation go? Does it go to 12% and stay there? Does it go up double digits? But make no mistake about this. In order to inflate the debt away, we're going to have high inflation for at least 3 to 4 years in order to attempt to inflate it away.
Oh, that sounds very grim.
Yeah, those are the risks. Those are the risks that we face. Yeah. So what I've been telling my colleagues and my clients is that my job now is to trade the mess. That's my new phrase. Trade the mess. I don't think we can hang on to anything anymore. Everything is a trade. And you have to be, I've been much more active than I have ever been in my career. Because we get to technical levels and we fail. We get down to support levels and we hold. And then we bounce back and forth. And thus, a lot of the consolidations that you pointed out at the beginning of this podcast. You see? So
okay, Angelo, I think we are under time pressure.
Yep.
So basically, to summarize, what we have been talking about is that basically you are worried about the coming of yield curve control, and which could be the catalyst for the second wave of inflation, which is historically normal thing to happen after you have this big first wave, and the implications on gold, right, and on the Ponzi stocks. Okay, well, thank you very much, Angelo, and I would like to invite Svata. I don't know if Svata can unmute himself.
Okay, I hope we can hear each other.
Yes, hello Svata, how are you?
Hi, thanks. Thank you for the insight, Angelo. It was great to hear.
Hey, I get to see your face. Thank you.
Okay, I got a few notes about Bitcoin, mostly.
What about these ETFs? It was a big thing on FinTwit. What is your insight on the creation of those new ETFs?
Yeah, sure. Maybe I will share my screen for a while.
Actually, Svata, before you do that, could you just tell us a little bit about yourself?
Myself, okay. Just a quick review. I'm data engineer for 20 years. And last year, I'm quite interested in Bitcoin. It's really amazing thing and invention. So I found a company to be in the industry for now, and still learning.
Okay.
And I'm trying to invest play some game on markets for a few years. It's the same song here. I'm still learning.
Hey, that's okay. We're all still there. You know, make no mistake. Economics, finance, and the markets are a lifelong learning project. It never ends. Okay. It always goes on and on and on and on. Why? Because the environment continually changes. The correlations continue to change. Actions by governments and central banks have influences on everything that causes different kinds of changes or unexpected changes. And so that learning process never goes away. So anyone that has a passion for what I'm going to call the investing game, all right, I think that's a great thing because I have it, you know, at least I think I do. You know, I look forward to every day and night so I can see what's going on and what's going to happen next.
Yeah, thank you. I feel that way too. Okay, can you see my slides?
Yes, we see your slides very well.
I got a few things why we can still hear the bullish talks about Bitcoin, because there are some things to come. First of all, and the only one thing which is certain is Bitcoin halving. It's some programmatically done fundament of Bitcoin, where supply will be halved and the new coins created every day will be there will be less of them since probably 15th April next year. It can have some impact on price. It had historically, but we don't know it for sure. It could be just coincidence. And what we know for sure, Bitcoin is or Bitcoin price is highly correlated with liquidity. So it could be liquidity more than halving the effect in history. We don't know that. What is really interesting is this ETF stuff. For now, we have more than 10 requests for new ETFs. And big whales and big animals like BlackRock, Fidelity, and other asset managers and wealth managers are included. So it's not just a game of some special funds interested in crypto. Not anymore. And I have to mention, I already said Bitcoin price is highly correlated with liquidity. So you said that before. Will J. Powell hold his line forever? Probably not. Probably we will see more liquidity quite soon, or not. And the last thing, which is more or less a speculation in the term of price, is impact of new regulations in the world. EU has this MiCA thing already in implementation, and it might help the market about Bitcoin. It might kill it. We will see again. But I will take a look at more about the spot ETF. We already have some ETF funds, Bitcoin funds already. It's about 2 years. They are in play. But none of them is spot ETF. What does it mean? The underlying asset is mostly futures on CME or some minor stocks or other industry-related stocks. But there is no ETF with Bitcoin itself as the underlying asset. And why is it important? Why it can change the game? I will show a famous chart about gold and what happened when gold ETF was approved. Again, we don't know for sure. It was because of this approval, but the coincidence is interesting, and most of Bitcoiners are waiting for the same effect. You will see if it happened. we know for sure that the approval of spot ETF will bring more money. There is a lot of wealth and money in the gates waiting to be able to get some bitcoins, because to have a bitcoin is quite a technical thing for now. All these things like cold wallets, hardware wallets, and addresses managing and all the stuff is quite difficult for most of people. If we had spot ETF which tracks the price in the bigger accuracy than these future ETFs, it will be very interesting for many people, many funds, how to get into Bitcoin. And the last thing, SEC was denying the requests for years. Why should it change for now? Something changed. One of them is Discord battle by GBTC, which seems to be winning, and they should be transforming their fund to ETF, to spot ETF. Also, there is a lot of requests, including BlackRock, which has some track record, about only one request denied in the history, so they probably know what they are doing. And we can see for sure a change in behavior of SEC itself. In last weeks and days, they are actively engaging all the issuers and in fact helping them to fill the requests and files in more detail and more appropriate way. So it seems the ETFs could be approved in the next month.
Now the question is if these ETFs will result in something that happens to gold, that the paper Bitcoin becomes a paper asset and it's shortable easily.
Yeah, that's a good point. The thing is, Bitcoin as a technology has a nice behavior. It's quite transparent. You can check every transaction by yourself, and Bitcoiners are hoping strongly that if there is some spot ETF in action, there will be also some proof of their assets, underlying assets. They can easily prove they have the Bitcoin they have. It will be quite hard to pretend you have Bitcoins which you don't have.
Okay, Svata, thank you very much for your update on the Bitcoin. And we have a last final visitor, Pete. Hello, thank you for coming.
Hi, everybody.
What are you watching
can
right
you hear
now?
me?
Yes, we can.
Can you hear me okay?
Yeah, yes. Svata, can you unshare your, yeah, thank you.
David, can you put up the your charts again on the RSP?
RSP, okay, let me put it back on the RSP.
Okay. So what I want to talk about is two parts. I want to talk about the nature of the market and the nature of the participants in the market, and you know, like Angelo said that he's never been so active, and both David and Angelo are saying, you know, take gains. You don't be investing in longer time frames right now, and I'm going to agree with them. I'm going to try to put a little color, understand why that is. Probably there's never been so much managed money that's being managed in shorter time frames. Historically, they were managing for the long term, and they would buy shares and hold on to them for a long time. And now we have a tremendous amount of money that's being managed on short time frames or even a tremendous amount that's being managed into strategies like that are very short-term, very levered derivative strategies like one day to expiration options that we've talked about in the past, which really move the market around in the short term. And to kind of illustrate, let's think about, what do investors need? What do these managed money investors need? You know, there's a concept called the hierarchy of needs in human beings. And I forget, was that Maslow or somebody, I think. Hierarchy needs air, water, food, shelter, you know, et cetera, down the line. What do these investors need? Okay. Short, medium term, and long-term profits so they can hold on to their jobs. When the market is sold off, they're looking to make money. Okay. As you get towards the end of the year, they're looking to make money. Okay. And so what we're going to see in the end of the year, often really the market bottoms in October. It can crash in October, but it really tends to bottom in October. That's what they try to do. And once it has bottomed, they will, especially if it's a low bottom, they'll find opportunities to run it up. So you can expect that. I think it's going to take some more bad news, substantially bad news, to continue this downtrend that which got going in late summer. Though I personally, I see this as a kind of a bullish market this year in context of a large bear market. And I think David and Angelo probably agree with that characterization. So what are they gonna, let's look at what do these guys need to do? They need to save their year, okay? And they're not gonna, they kind of, it's gonna be really true at this point. Are they gonna buy stocks that don't have a good story of declining fundamentals, but have gotten really cheap? Are they really gonna buy those unless without a really strong catalyst and change of the macro? Not at this time. But they are going to buy, when it comes time to buy the dip, they're going to buy the stocks that are carrying the market. And what's the biggest bull market going on inside the market this year? I wish I could have a two-way conversation. Raise your hand if you know, kind of thing. Well, it's artificial intelligence, right? It's in a huge bull market this year. It has established a new bull market. It's a bull market within an overall bearish market. So I'll try to understand, my idea here is to try to understand some themes and what the time frame really matter. So the first theme I'm going to talk about is artificial intelligence. Okay, I think it's a big theme. I've done some research on it. I've read a lot on it. It's a big theme. It's captured a lot of investor participation. I think NVIDIA is now one of the top 7 stocks. It's one of the biggest stocks in the market. I think it's $1 trillion stock now, or close to it. It's a big number, and it's emblematic of AI. It's the biggest name in AI. For your own edification, I would research AI and start to learn the sector. And when there's pullbacks in the market, be ready to participate in it, because it's going to be a leading sector in the recoveries. But I'm not recommending you buy anything at this time, per se, but understand the concept. Buy the dips on the big winners. So AI is a big theme. Another big theme, in my opinion, it's a longer term theme, and it varies, but energy. There's a really big underinvestment has happened in fossil fuel energy, and there's a big politicized ideology about what the energy future is. But the fact of the matter is, if you reduce the amount of energy available in a society by 30%, you're going to do a lot of economic damage, and that's not politically going to hold up. So fossil fuel energy is going to continue to have a big role, particularly in the developing world. they're going to only burn more and more fossil fuel energy in the developing world. There's no doubt in my mind about that. The only limiting factor is air pollution. And so in a city like Shanghai, they want to build nuclear reactors to stop the air pollution, which is part 2 of the theme. There's a lot of nuclear energy projects are in the queue to be built, a huge amount. And there's been underinvestment in uranium mining, and investing in nuclear energy is a long-term theme, but it's again one that you can take a position on dips in the in the market. And I don't mean like a dip this week. I mean well, we just had the market go down for 2 months, maybe a dip like that for a rebound. And you can see that actually, that wasn't the market. Let's see. Looks like it went up in August and September, and the market was going down. Am I reading that right, David? I think so. So both fossil fuel and uranium are those are both underowned, underappreciated sectors. All right. Another big theme is going to be reindustrialization in the United States. We already know about that. It's onshoring. They have to pull it back from China. They'll try to outsource to other Asian countries, maybe Mexico. But the U.S. is addicted to low-cost manufactured goods, and this onshoring problem is a inflation. It's what was a very big disinflationary factor is now reversed, and those goods are going to cost more than what they did before. So part of the onshoring theme is it's an inflationary pressure, and my idea is that the United States has not the labor force it used to have, and it's also an increasingly expensive labor force. And I think that automation of the United States industrial base is going to be enabled by AI, enabled by technology in general, and also enabled by the relative. So Rockwell Automation rather, which is a leading blue chip industrial company that's a leader in automation industry. Just one name, but it's a good space to understand. There's going to have to be, yeah.
Hey Pete, would you say that the U.S. will? Can you hear me?
Yep, can hear you.
Yeah. Would you say that the U.S. will excel at high value add manufacturing?
Probably.
Yeah, versus low value add, which may end up in Mexico. Low to medium value add in Mexico.
Well, we're kind of speaking very subjectively, but I think that Mexico's ability to produce is not huge. I think it's a society that has a lot of problems, but it's substantial and it's increasing. But the scale that we're talking about, but I think the main point you're making is that low value added manufacturing is still likely to be outsourced to developing countries.
David, if you put up the straight up Mexican peso, it failed today. Go ahead, Pete.
Yeah, okay. So that's another theme which
peso
plays into peso. I don't know what the symbol is.
Oh, just do the Mexican peso futures, which is where's my FX futures? Just bear with me one sec. 6M1 exclamation. That's a nasty failure right there.
Okay, well, I'll go back to where I'm going with that. So how the developing world reacts to that? I mean, I tend to think the developing world has healthy enough politics and has decent demographics and commitment to education and progress. It might be a country like Vietnam, or there's different countries that are they're going to be growth. They're part of the offshoring in China, and onshoring is those countries. So that's part of the theme too. And understanding those themes kind of gives you a base to make investment decisions. And I personally think that one should be maintaining a lot higher liquidity on an investment portfolio. Unfortunately, you can get 5% or more in U.S. Treasury bills while you're holding on to your liquidity, because I think there's a lot of volatility, and there's going to be a lot of bargains, and there's a lot of fast-paced developments going on. So keep a lot of powder dry. But if you want to have some money in some themes, have a little position in something and hold on to it. You don't have to trade your whole portfolio. You can own some of these things and hang on to them. Like India makes the graph. Well, if you already own India and you want to take a profit, you don't have to sell it all. That's my point of view. If you don't own India yet, wait for an entry point. Don't buy it yet. You can see right on the monthly. It's the ETF is
in the middle.
Yeah, you could maybe buy it again later. $4 or $5 later, it's cheaper. 10% cheaper.
Yep.
You don't have to be an expert and trade everything, in my opinion. That's my opinion. But you have to trade the right size. So if you have a big position in something, you have too big a part of your account, you can't make good decisions. The short term can trade you off what you thought you were going to, chase you out of what you wanted to do. So keep your positions smaller.
Yeah, totally agree with that, Pete. And by the way, guys, there's a technical path for Treasury bills to go to 7%. Actually 7.7, which is their historical opening range.
Okay. All right. So I'm gonna go. That's my last theme.
Okay.
The last theme is something that Angelo was just talking about. Okay. And what we're talking about is that it's fiscal dominance, which includes the United States borrowing money to pay its own debts now. Where if the inflation caused high interest rates, and high interest rates cause more inflation on the deficits, because now it's $1 trillion a year worth of interest. Government can't afford the interest, so the deficits go higher and higher and higher. Any slowdown, they're going to spend. It's like rats chasing each other. The more they spend, more deficit spending, the more inflationary pressure they create. So it's really hard to understand what's going to happen. But one thing for sure is going to happen when something gets near a breaking point and some trend is in place. That, Angelo brought up the example of gold. The gold's under pressure because interest rates are now higher than the inflation rate. That's called a real interest rate. It's positive. So, but that's going to flip because they're going to have to abandon high real interest rates and go to structurally negative real interest rates to depreciate their debt against the economy, or have a prayer to do it because they can't afford it. And that's when there's going to be headlines, and the Federal Reserve is going to start doing, first it's going to sound like something, they're going to try to make it sound like it was something else, but what it was tricks to take the debt off from the Treasury, off the Treasury and the national balance sheet, and to create a buyer, because there is a shortage. I think I've read that in the next in a 2-year period, something like half of the outstanding debt in the United States has to be resold. And something like that, some huge numbers, like $15 trillion. Who's going to buy it? Who's going to buy all that debt? And China used to buy a lot. Saudi used to buy a lot. The banks used to buy it. The banks were told to buy it. Foreigners generally would buy it. A lot of those those sources of demand for those built treasuries has dried up, or it's way down. The interest rates have to be really sexy, really attractive to attract buyers, but the government can't afford to pay those interest rates. The Fed's going to step in and be the buyer and try to buy everything down. When they do that, that's going to be a trigger on gold. So my point of view on gold is, I kind of have the same category that we would have treasury bonds in a portfolio, a non-correlating asset, an asset that may go up when stocks go down, that serves some other function, like over a long period of time. Gold gives you protects your wealth in inflation adjusted money. But you can see that especially non-dollar currencies. Like if you did whatever yen versus gold over 20 years, you would say that it was the guy who had taken his yen and bought gold 20 years ago. It's way better off now. So that's the kind of time frames. But again, like gold, okay, if you put that in a portfolio strategically, maybe that's a 5% in a portfolio just to hold on to. Could gold go lower? Yeah, it could. Maybe it goes 1,600, maybe go to 1,500 briefly. But there's going to be a headline where it all of a sudden goes screaming, because this problem with the debt in the Treasury Department and the interest rates and the budget deficits is not going to heal itself without some kind of very strange artificial intervention by the Federal Reserve, which is going to be crazy bullish for gold. So anyway, that's about all I had. I just wanted to reiterate, investors, big money, managed money. They have their own hierarchy of needs. It's to keep their job at the end of the year. It's to satisfy their egos that they got the right trade, and that they're become more and more short term. And we see it in what they call the Magnificent Seven, which NVIDIA got into that list this year. They're the stocks that these guys buy on a dip to rocket their portfolio outside of a pullback. And it's good to understand that these guys need a go-to asset that will meet their needs. So that's all I had. If anyone has any questions.
And Pete, they need to be liquid enough, and they satisfy all those criteria.
Yeah, that's true too, because by liquid, the size, when somebody's managing $1 billion, which is not unheard of here, and they want to buy something that's going to make a difference, well, they need to buy like a 3%, 5% position. That's 3% is 30 million. What's it? 3% of $1 billion is 30 million, I think, and 10% is 100 million. Let's say they want to go 100 million into, they got a lot of compatriots who are doing the same thing on that kind of size. They have to buy stocks. NVIDIA, $1 trillion. How many? Apple, almost $2 trillion market cap. I mean, they can buy size in those stocks, and they can sell them too. So that's another reason why they're going to the big ones. It's a good point, Angelo.
And David, next time we'll have a primary discussion on market structure, and I'll speak specifically towards the options market, one day to expiration, and we can talk about the CTAs, the vol control funds, all that sort of stuff that are having an impact on the day-to-day movement of the markets, but have nothing to do with the fundamentals. So,
Angelo, I would add, like, it's really important that everybody in the room gets to understand how that impacts their portfolio or their decisions from the day-to-day basis.
Yes, it makes it harder, for sure.
And they're a major reason why things have gotten short term.
Yes, absolutely.
So right now,
it's all about with the mechanical flows. The 401k.
So in conclusion, these guys mostly can only buy; they can't short. So there's a lot of long only investors. So they're ability to, I'd say right now, the ability of short sellers to really push the whole market down is limited, because there's all these pensions and institutional guys who are ready to buy the dips, and they have way more money, you know. And we're going to keep seeing two-way volatility, and just hang on to your hats, and also let's pay attention to the relative, you know, like if we look at RSP, or let's just look at NVIDIA versus the SPY. Can you like pull that one up, David? NVIDIA SPY. Okay, so we can see things here in this chart. If you like follow that, on the monthly, the one in the top right quad box, I mean, that's a pretty noticeable trend.
Yep.
If over the years here, you can see that. Like if you, and probably that's how it did relative to that S&P 500. Well, probably I know the last run for sure, when it turned green versus the S&P 500. After that, it not only beat the S&P 500, it made a hell of a lot of money, like 100, 200%. And that's a good thing to pay attention to if you want to know what do the guys want, what do they want to buy, okay? And after that turned green, they wanted to buy NVIDIA. And what's NVIDIA today right now? It's up slightly. I don't know. Just for, I mean, the S&P got slammed.
Yeah,
it was down over one.
Yeah,
it was down over 1%. Yeah, NVIDIA was leading the market today. It reversed, but it's basically flat. So, you know, it's they usually they want to buy it. So, and I think into year end they'll need to buy something if they possibly can. It's very rare that they'll stay on the market will stay in a bear market right through November and through December.
Yeah, the question we have to ask, because the key level on SPX was 4,200, and it was tested overnight. It did not get tested during regular trading hours. So, and October is still young, so you know, we either saw the low for the rest of the year, or I mean, we can still see you know, 4,200 during regular trading hours. So we just don't know what's going to happen. It's short-term moves. You have to trade one options level to another, take profits, and watch for next move. I don't see here a home run setup.
Yeah, and David, that 4,200 level, a lot of people saw that level. And how often do you see a level that everybody says that's a level, that's a level, and they in the futures market or something, they'll take it, it'll get taken under that level, and it'll hit stops. There's people who have sell orders there, because it got below that level.
Yeah.
And boom, 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 they'll sell into that, and boom, boom, these, I don't know who they are, but they bought it, and the guy who was selling it, he was on the wrong side.
So we might, you know, we might still see that level, but at this point, there's no certainty. The correlations have lowered, so I don't see a big risk contagion. I mean, when the correlations go down, that means that market participants are doing their strategies. They are buying something that they think it will be a good. When correlations go up, that means that everybody is forced to do whatever the market does, right? So everybody's doing the same thing, so they are forced. And when correlations go down, then that means that people are actually investing. At least this is my interpretation of the correlations. And especially if macro market starts correlate strongly, that means that's a really big risk. And we saw it. We saw it in in late September, but yeah, that is now over. We first saw in July, in June, correlations got quite high. Then in July, we got macro correlations high, and that was our indication to get out of longs. And now, I don't know. I don't see anything anything significant, and I don't see a setup. So we'll see. We have to just go day by day. I trade mainly option level nows on QQQs on SPX, and let me tell you, that stuff works. If you are on the low of range, you go long from these strong option levels. You don't go, you don't catch a falling knife, but you wait for price to start going up, and then you are buying retracements from those options levels, and you do it like an open range breakout style, and it just works. It just works like a clockwork, you know. So
David, do you scale? Do you do like kind of scale into those positions? You know, like buy some, or buy some more, buy some more.
No, I do it. I do it on leverage, and I do it. I just buy that level, and if it doesn't go immediately my way, I just get out for very small loss. And you can do it because it works that well. It's the hamster style, you know, and it works. So you don't trade the open range anymore. It's out. This trade is not working. You trade these big options levels on pullbacks. Not you don't fight when price is going down. You don't buy immediately. You let it wiggle around, and then they start buying. Then they retrace to important options level, and then you buy. Yeah. This is something that just works, and you need to take profits. You don't wait for hundreds of SPX points. You take some profits after 20 points, and then you take some profits after 50 points. And if you manage to get 100 points, you're done. Like you don't leave even runners in this environment. So this is, I think, what has been working the entire year the best. And if you are in positive gamma, you go long. If you are in negative gamma, you go both ways.
Yep. And that's what you're describing, David, is basically what I was talking about when I first started my remarks, when I said I am more active now than I have ever been in my career. And that's why.
Yeah. Yeah. So there is no buy and hold except short-term treasuries.
Exactly. Exactly. Well,
Okay,
David,
guys. Well, thank you very much for your participation. It was
David. Hey, David, I did have one quick question
uh,
from you. Any comments about VIX and the instruments to do VIX? And should we? I mean, I think the instruments, the ways of doing VIX are problematic because they're derivative portfolios that a lot of them they just decay. But the idea is that if you could buy the volatility index when it was cheap and just hold on to it, if you could just hold on to it and it didn't decay away, eventually volatility would come back and rock you right out, especially with all the bad news around. But anyway, how do you look at it?
Peter, it's very simple. It's like with commodities. You can buy USO when there is a backwardation in oil, and when there is a backwardation in oil, it's usually bullish. So you can hold USO. Now many commodities have backwardation. So when you are holding those ETNs, those exchange traded notes that are trading the futures, you will just make money by holding it because there is backwardation. In VIX land, there is, as you can see, oh, actually, I'm not sharing my screen, or yeah, I'm sharing my screen. So as you can see, there is contango. So until there is contango, you cannot really hold a long-term VIX position. I'm holding VIX M. VIX M is holding basically the middle of the curve, and the contango is much smaller, but it's still there, and the position is just losing value as well, but not as fast as you would be holding the front end of the curve. But and this is what it is like when you see backwardation in VIX, then this is the moment when shit hits the fan, right? So until we get backwardation in VIX, we are in consolidation. We are not crashing. Also, there is this new thing. It's the zero DTE. So VIX is looking at 30-day options, right? And zero DTE has a different implied volatilities. So yeah, the VIX is no longer as informative as it used to be, but I still watch it very intensively. And when we get to low of range, like we did last time to 12, of course I bought some VIXM, and now at the top of range I sold it. But what is working the best is SVIX, because SVIX makes money from the contango. SVIX is basically the one that makes money from the contango. Yeah. Unfortunately, the risk is overnight. You are every night or every weekend you are facing a risk of volatility spike over the weekend. But yeah, SVIX is something how you profit from the contango.
Okay, that's excellent. And then it's also something to do when you're buying the dips in the market. And if you don't want to hold it overnight, you can, if the market opens down sharply in the next 15 minutes or some very early part of the day, all these the VIX will chase the market higher. It'll go up as the market goes down, and then I think you can look at SVIX if you want to own something for a bounce. And I think it responds very well when there's a bounce.
Yep. Okay, I think we are out of time. It was a really interesting presentation. So thank you, Angelo. Thank you, Peter, and thank you, Svata. I'm glad we have such a great team here at Marketimers, and I'm glad that you are using the tools that we have created with Angelo. We started, more than 2 years ago, and the goal of these tools is that we have a repeatable elements in our process, and these ranges is something that everybody, every fund, every trader, everybody is doing something similar. Everybody is looking, is the momentum green or red? Is there a trend or it's just a chop? And what are the probabilistic ranges of that? We might have a little bit different calculation than some others. And the difference is that somebody might call trend earlier than we or later. But in general, this is the stuff that everybody's watching. Momentum, trend, and some sort of probabilistic ranges. Where is the extreme? Where the price will oscillate, mean revert. And by making certain way to calculate and use it on all the markets, I think we have a huge advantage that we have a repeatable process to find execution points and to find trend and momentum. Okay, but the ranges are not made of concrete, right? So they can get really ugly. They can be destroyed very ugly. So the ranges, they are there to help you with risk management. And if ranges are not holding, you have to manage your risk.
Yep.
Okay, thank you very much and have a good day, everyone.
All right, ciao.
Ciao.